Can non-residents avoid Canadian rental taxes through offshore companies? It's a question that comes up more often than you'd expect. Can I use an offshore company to avoid paying tax on my Canadian rental property? The short answer, not legally. Some non-residents believe that registering their rental property under a foreign corporation or using a trust or shell company will shield them from Canadian taxation. But the Canada Revenue Agency, CRA, has specific rules that look through these structures and still assess tax on Canadian source rental income. Let's break down why offshore strategies won't exempt you from CRA rules and what actually works if you want to reduce tax the legal way. CRA tax rules are based on source, not structure. Canadian tax law focuses on where the income is generated, not where the landlord resides or how the entity is structured. If the rental property is physically located in Canada, then the income is Canadian source and it is taxable in Canada regardless of ownership structure. That means it doesn't matter if the property is owned by a foreign individual, a foreign corporation, an offshore trust, a nominee, a numbered holding company. If rent is being generated from Canadian real estate, the CRA wants its share. The CRA looks through the entity. Even if you set up a shell company in a tax haven and use it to hold Canadian real estate, the CRA has tools and legal provisions like beneficial ownership reporting to identify the true owners and enforce compliance. Plus, if your offshore company owns Canadian property, it may need to register with CRA as a non-resident corporation, will still be required to file annual tax returns in Canada, may be subject to Part 3 withholding tax or Part 1 tax depending on structure, could trigger additional reporting obligations under international treaties, and if the CRA suspects tax avoidance, it can launch an audit, apply penalties, and report your case under international financial sharing agreements. What about using a Canadian corporation? Some non-residents ask if forming a Canadian corporation to hold rental property is a better alternative. While this can offer some tax planning flexibility, it involves setup and maintenance costs, triggers corporate tax filing requirements, still subjects rental income to Canadian tax, doesn't eliminate tax, it just changes how it's reported and paid. The smarter approach? Use Section 216. If you truly want to reduce tax legally, the best path is to elect under Section 216. This lets you pay tax on net rental income after expenses, claim deductions like mortgage interest, property tax, insurance, and more. Avoid the flat 25% gross rent withholding. Get refunds if you've overpaid. No loopholes, no risk, just smart compliance. If you require assistance with Canadian tax matters, our team is ready to provide reliable professional support. Please contact us at 416-283-8774 or visit theaccountingandtax.com for more information. And if you found this video helpful, don't forget to like, subscribe, and share.